So today we are going to explore the nuances of cash-on-cash returns within commercial real estate investments. We'll cover what happens when the numerator and denominator change and whether the metric is still valid once all equity has been returned. We'll also provide a comprehensive Excel model template for calculating cash-on-cash returns, which is the subject of today's video. This video itself is styled as a follow-along video, meaning you will see how I build a cash-on-cash model live and my real-time, slightly unfiltered thoughts as I do so. So what are cash-on-cash returns? They represent the annual return that an investor receives on their investment based on the amount of cash they put in. It's calculated by dividing the annual pre-tax cash flow by the total cash investment. This popular metric helps investors evaluate the potential return on investment, but it has its limitations as a standalone criterion. Therefore, it's crucial to consider other aspects of evaluating a deal's profitability, such as net present value and internal rate of return. Throughout this video, we will cover various aspects of cash-on-cash return in commercial real estate investment, such as leverage and its impact, drawbacks of cash-on-cash return and alternative metrics to consider, and exploring cash-on-cash return scenarios. We will also provide a detailed overview of the cash-on-cash return definition and its limitations. Finally, we will share this custom-made cash-on-cash return template as a download designed specifically to help you analyze commercial real estate investments. This template offers a comprehensive framework for assessing potential investments while taking into account all relevant factors regardless of the asset class. By the end of this video, you will have a deep understanding of cash-on-cash returns in commercial real estate investment and be equipped with a valuable tool to assist you in making informed decisions about potential investments. So, cash-on-cash return as defined. Cash-on-cash return is a metric used to measure the cash flow generated by a property relative to the amount of cash invested. It is expressed as a percentage and calculated by dividing the annual pre-tax cash flow by the initial cash investment. For example, consider a property that generates $50,000 in pre-tax cash flow per year and requires a total cash investment of $500,000. The cash-on-cash return for this property is 10%. This metric is useful for evaluating a property's income-generating potential, particularly for investors prioritizing immediate cash returns. However, it is important to note that cash-on-cash has its limitations and should not be the sole criterion for investment decisions. It is essential to consider other factors and metrics when evaluating a property for investment purposes. Leverage plays a significant role in cash-on-cash returns for commercial real estate investments. Equity investors often focus on the levered cash-on-cash return, which takes into account the effects of debt on the investment. Financing terms can greatly impact cash-on-cash, and it is essential to consider these terms when calculating and interpreting results. Key factors affecting cash-on-cash due to leverage include the interest rate, the loan term, the loan-to-value ratio, which I'll put here, the amortization schedule, and inflation. For example, let's assume an investor financed their $500,000 investment with $400,000 of debt at a 7% fixed interest rate with no amortization. So let's reorganize these things here. Pre-tax CF, investment, boom, boom, interest rate, LTV ratio, financing proceeds would be $400,000. Let's change that. So let's build a quick sources, equity, debt, total sources, So your financing proceeds are going to go here. Your total sources are going to match your total uses, which is just purchase property. We'll expand that later, so I will keep some space. That's your investment. And your equity, let's just create a cash flow. Purchase property. Pre-tax CF. Year 0. D45. Control. Zero that out in the first year. Link to our pre-tax cash flow right there by hitting F4. And then let's just have a growth rate. Whoop, too far. Center these. Purchase our property. Zero in all the other years. That's our unlevered cash flow. Refresh this. So some metrics that are worth considering are your unlevered basis is here. So unlevered cash on cash can be measured pretty simply by taking your free cash flow over your unlevered basis and then multiplying that by -1. You'll see a familiar metric there. So our unlevered cash on cash, which is the same as our levered cash on cash if there's no debt, is 10% growing to 11.3%. People often quote cash on cash in ranges for this purpose, but let's add our levered cash flows. So let's call it acquisition debt. We're going to link to it here, rename that. Now, of course, debt is never free. We need to have interest expense. So what I'm actually going to do, I like doing this, is putting these things next to each other as percents and dollars. If you're curious about my Control-Shift-K shortcuts, I'm using a tool called Macabacus, which I highly recommend. It helps you go a lot faster in Excel. Acquisition debt. Let's call it that. And then your dollars there. Let's put that there so it aligns. And then your interest rate, it's going to be fixed for this example. It'll be that times that. Let's put interest under LTV. Kill the dollar sign since that's a secondary thing. Take these zeros, drag them out because that's 0. No interest in year 0. And then there's more nuanced ways to do this, but just dropping in a direct link there with F4 works. Let's type Alt HOI to resize our columns. And then levered CF. Let's copy that. Alt EST, enter. And then that's going to be the sum of our unlevered cash flow plus our levered cash flow items. Refresh. So levered cash on cash is going to be a similar formula. It's going to be this divided by that times -1. And you can see the impact of leverage on our cash on cash. It has an immensely beneficial impact. Obviously, it has the upside of decreasing your denominator to just $100,000, which we will bring into our sources and uses here. Sources should always equal uses, by the way. Let's add some unlevered operational assumptions there. Take that, move it up. Yeah, so your levered cash on cash is higher. Obviously, you've got the uplift by decreasing the denominator because your equity check is only $100,000 thanks to the $400,000 of debt, but that debt is not free. You have to pay a fixed interest rate on it. So all things equal, you still get a boost in your levered cash on cash, but it can be tough to follow this metric when certain things happen, which I will dive into in a second. So if you, just to recap, we bought a property for $500,000. We financed it with 80% LTV debt to issue $400,000 in loan proceeds. That means our equity check is $100,000. This property, dummy pre-tax cash flow, obviously there's more nuance behind that. NOI, capital expenditures, but just to keep things easy, let's say that grows at 3% per year. You're looking at an unlevered cash on cash range of 10 to 11.3% and a levered cash on cash range from 22 to 28.3%. Now, cash on cash can be a bit awkward to discuss because it does change over time, so investors typically quote ranges, but let's dive a little bit deeper into the nuances here. Cash on cash return does not account for the time value of money, which is a very important metric in real estate. Two items that do account for the time value of money are going to be your IRR and your NPV. So what are either of these metrics and what do they represent? So an IRR equals, in Excel, just that formula. If we were using dates, we would use much more interesting formula called XIRR, which takes into account dates, but I'm just using the basic equals IRR formula for now. You'll see we've got a pretty bad IRR. That is because we do not have an exit value, so we just bought a property and it evaporated. So let's just go ahead. We can make this a lot more nuanced later, but let's just start with exit value equals $600,000. This is obviously not how you would do it in an institutional context, but it is easy for our quick model. So here we go, exit value. Now, let's just throw it there. You'll probably notice it gets a bit clunky if you want to change your timeline, and you have to be careful with these sum formulas when they're done like this because it may not automatically be included depending on where you add the new row. So let's add the exit value. You can see that gave us a lift in IRR to 13.6%. Now, what is NPV? Actually, quickly, what is IRR? This is the rate of return on your investment annualized, meaning you put in this much money unlevered without taking into account the debt, and you got all this money back. What is the discount rate that sets the net present value of these future cash flows to that initial $500,000? Meaning, what is the break-even return hurdle rate? That's all fancy ways of saying that this is the flip side of the equation. So at a 13.6, exactly zero. All right, so really quickly, I went ahead and turned off the recording and built a quick data table using dynamic arrays to explain the concept of NPV. So NPV is net present value. This takes account the time value of money of discounting every single cash flow in your projections at a fixed discount rate. Now, knowing what we know about the internal rate of return, if we set our NPV to our internal rate of return, then if we set our discount rate to our internal rate of return, then we know that our NPV will be 0 because the IRR function is built to solve for the discount rate that sets your NPV to 0. So that's a given, and you can see my unlevered NPV, a 13.6, gives me a 0 NPV, and for my levered NPV, a 34.4% discount rate gives me a 0 NPV. That is what is going on there. And you can also see it's a bit unfair to really judge your unlevered cash flows at a discount rate that is appropriate to your levered return. But just for example purposes, you can see that a 34.4% discount rate gives you a negative NPV on your unlevered cash flows, which makes perfect sense because anything below a 13.6%, which is your IRR, which is the break-even discount rate effectively, should be giving you a negative NPV. Let's move on. I have a couple more formulas to show you. This one does not take into account the time value of money. It is called a multiple on capital, also known as an equity multiple. But the gist here is you take all of the money they're earning. So let me just sum this manually for you so you can understand this formula. So you make $865,000 and you spent $500,000. I'm going to put a -1 there so that the formula doesn't result in a negative number. And all you do is divide all the money you made by the money you spent. This is a slightly fancy Excel formula that just takes all the positive numbers and divides them by all the negative numbers and multiplies it by -1 again so that your multiple doesn't show up as a negative number. Same exact math here, just on the levered cash flows. So we've covered quite a bit in this video thus far. We've got your unlevered cash on cash return, you've got your levered cash on cash return, you've got your IRR, your multiple, both unlevered and levered, and you've also got an NPV table up here, which frankly may not be the most helpful metric, but it's helpful to understand what's going on with an IRR. Now let's look at two metrics that are only relevant to debt investors. That's going to be your debt coverage ratio and your debt yield. So your debt coverage ratio, your DSCR, debt service coverage ratio, I'm going to call these credit metrics and just put them under a little blue header for no particular reason, just to make it easier. So your debt service coverage ratio is going to be the payment that you have to make on your debt, your NOI divided by the payment that you have to make on your debt. And that DSCR is pretty healthy. It really depends on the lender, but you start seeing issues in loan documents if your DSCR dips below like 1.5 or 1.35x. So this is a healthy debt service coverage ratio. And now your debt yield is pretty straightforward as well. It is going to be the NOI on your property, which let's just say this pre-tax cash flow is exactly equal to our NOI, divided by the size of your debt. Our size of our debt is not changing, so we're looking at a 12.5% debt yield there, which you can also calculate by figuring out your LTV and your pre-tax cash flow and your investment. So again, debt yields really depends on the lender and the risk involved in the project, but this is a sturdy debt yield, especially since you're basically going in at a 10 cap, assuming this is NOI. So these are all metrics that are super helpful. And right now you might be thinking, well, what's the point of all these metrics? Everything has its weaknesses and strengths. Now, one issue with cash on cash that we have not yet explored is going to be that your equity denominator actually changes. And that's because this money, when it's a positive in a levered cash flow, is actually being returned to your investors. So if I look at my equity schedule, let's do equity schedule. Again, I start the investment with $0 in equity. I fund my initial equity, so contributions, distributions. And so what is a contribution and what is a distribution? A contribution is going to be any negative levered cash flow because that means you're putting money in. So this is min of this or 0. And so let's drag that out. Obviously, we only have one contribution. Now your distributions are going to be the opposite, max of this or 0. Oh, nope, just that. And now your equity is actually going to be the flip of those two things, because the balance of your equity will increase when you contribute and decrease when you distribute. So let's just bring this around. And what do we have going on here? We have an equity that approaches near zero. So we have to update our cash on cash. Instead of using this fixed reference, we should use the beginning balance in the period to calculate our cash on cash. And you can see that things start to get a little wonky because you're not really generating much more cash flow, but what's happening is your equity is actually going down. And that's a problem because cash on cash, from a strictly calculated perspective, is on the equity that is reflecting your skin in the game of the project. Now you can do levered cash on cash on initial equity, which a lot of most people end up just using this one because it feels better. And the philosophical angle is to say that, oh, well, this is the money I put in, so I'm only curious to know how much I get back in every year as a percentage of that. But as deals evolve and skin of the game changes, this is also a relevant way to look at cash on cash, because really you've gotten all this money back and you only have $30,000 in the game at this point. So these are two valid ways, and this is where the nuances of cash on cash start to become a bit difficult to wrap your head around, even for institutional investors, because the meaning changes. Whereas with IRR and multiple in capital and NPV, their meanings are a lot more well-defined. Let's say that your rental income is going to change. So starting with rental income, let's assume a 70% NOI margin just to back into the dummy figure. So that divided by that, we take this, hard code it, take this, grow that. So we're going to grow my revenue growth rate, and let's do OPEX growth rate as well. Revenue growth, OPEX growth. Let's do 3% as well, just to keep things simple. So let's say this is our first revenue, was that times 1 plus the growth rate, should be the same number. Now we want vacancy loss. Let's just say potential rent vacancy. Let's say there's 0% vacancy loss, just to keep our numbers the same without doing too much dummy math. I'm gonna add another row here. You can see these boxes get annoying. I usually put outputs on different slides, but you can see 0%. We can tweak this later. So equals that times -1. Again, nothing for now. We'll add it later, and we'll just call that total revenue. Oops, don't want to call that year. Let's go into here. So that is your total revenue. I don't want that bottom border actually. And then now let's do OPEX. This is going to be where we, again, a real model is going to be more nuanced on your revenue and OPEX assumptions, but this will suffice and you can plug your own figures into here. So OPEX, let's just say it's the difference, that minus that. I like showing things as negative numbers. Let's lock that in as a hard code, and similarly grow that by the OPEX growth rate. Don't want a dollar sign if it's a number under a subtotal, so let's remove that. And that is our NOI. And again, same formatting as this, so let's just do that. NOI is there. Last thing, CapEx, $0 whole way through. And that gets us to our pre-tax cash flow, which is now going to be a sum of those figures rather than a hard code in and of itself. I'm going to delete this and we can just have our assumptions there. I'm going to create valuation section. Again, this is kind of an ugly looking summary. We would seek to beautify this at the end of building the model, but don't get too caught up during the process. So you can see here, our cash on cash is kind of weird when you sell the property. One way around that is we can do with a backup section. So I'm just going to actually put a little thing over here just to make life easier. Cash on cash and yes, yes. So I'm using ones, not 1%, but actual ones to represent whether something should be included in cash on cash. I'm excluding the subtotals. Let's just drag all these down with Control D, delete, so no subtotals. Again, you can automate a lot of this stuff. I actually don't want property purchase or exit value to be included in my cash on cash flow. And I'm just gonna change this formula. Instead of using this just straight link to D, I'm gonna use sum ifs. I'm gonna look all the way here. That is 1. So anything without a 1 gets excluded. So now you can see I've removed the noise from the sale because cash on cash is typically meant to be a yield metric, which is to say what is your cash yield during the hold period. You'll probably also notice I don't have a rolling or changing valuation for this. You'll notice I made a big comment earlier about how your equity could change. I don't do that for your unlevered. You could theoretically have the property value fluctuate, but that's probably getting a little too cute. And again, I believe we should just drop these things in. No on the acquisition debt, yes on the interest expense. And same exact formula, I'm just actually going to copy it. And replace it. And I preach against using the mouse, but sometimes it's nice. 47. We want to go to 47. That's why we get that value error. It's F. Boom, boom, boom. And then I'm just going to take that. And instead of being there, it's going to be on that lockdown figure. And now you can see when people talk about cash on cash, they're usually referring to this metric because most people don't want the equity denominator changing because then things start to look a little crazy like this. However, it's important to understand that the equity denominator can change in lots of documents that funds use, especially these open-ended funds, will make these sorts of changes to your equity denominator, and things can change even more rapidly if you have a cash out refi. Let's say you here, this will be let's say you have a cash out refi with equals sum that times 1 with additional proceeds, so you pay this down, but then you also get an additional $500,000 of proceeds. Well, now you don't have any equity at all, right? So your cash on cash kind of doesn't even make any sense anymore, right? So if you have a cash out refi that happens in the middle of your hold period, again, that's just you're paying down your initial $400,000 loan for a $500,000 loan, then it's kind of an interesting situation. Obviously, your interest expense would need to change as well. So this is kind of a dumb example because your interest rate expense stays unchanged, or I guess theoretically, you could say that you got a new loan with a 5.6% rate, but you get the point. The cash out refi kind of messes the whole deal up. I'm going to delete that. And you can see we go back to positive here. So cash on cash can be very nuanced. Let's check out a few more scenarios. Obviously, if so if our rent increases, let's say by equals that times, let's say, let's say 10%. You can see our cash on cash increases in both scenarios. And I'm going to do the same thing here. If your OPEX decreases by 10%, this may not be the best way to actually model it in the real world, but it just helps convey some of these core concepts. You can see further benefits, your cash on cash, zero those out, back to our 10. So that's important. Changes in the financing terms. So if my interest rate goes from a 7 to an 8, as expected, just hit refresh. My cash on cash will go down. My unlevered is unaffected because interest does not impact your levered and unlevered. The interest doesn't impact your unlevered cash flows. Your levered are the only cash flows that get impacted by a change in interest expense. So yeah, this is just a really quick dummy Excel template. I hope watching me build this was informative. And if you like our stuff, make sure to check out the website, leverage.breakdowns.com. Happy to answer any questions you might have in the comments section. We have a networking Discord channel, which you can find on our website, leveragebreakdowns.com, and there's a button that says networking, and so that should be very easy for you to find. And thank you so much for watching this video, and I look forward to putting together the next one.